Hello students, let's travel together to the educational journey which we have started on essentials of financial management. Here I am going to share with you the discussion on the sources of finance, where after completing the overview of sources of finance, equity share, now I am in the process of discussion on the preference share. So, this discussion will be purely based on the ownership securities, where in addition to the equity share, preference share capital has also been considered a very important source of fund for financing the long term investment, growth or expansion in the company. Here preference share will be discussed under different heads such as introduction of preference share, features of preference share, types of preference share, its advantages, disadvantages and also the suitability of the preference share. Here, as far as the concept of preference share is concerned, it can be defined as a share which has preferential rights over equity shares in payment of dividends and also in repayment of capital. So, here as the name is suggesting, preference share is called preference share because it is enjoying a preferential right over the equity share in terms of payment of dividend or whenever the repayment of capital is made during the liquidation of the company. This is also unique type of long term financing. Why it is unique type of financing? Because it is a hybrid security which falls in between the debentures and also the equity shares. Now, we can discuss the characteristics of a preference share under the four head. Number one being the maturity of the preference share. The main attribute of preference shares lies in the fact that it is also a relatively permanent capital to the company because preference share has a defined lifespan or a specified maturity period, and on account of this can be divided into two type of preference share. One, the redeemable preference share and the irredeemable preference share. So, if it is a redeemable preference share, then it has a definite maturity date after which it would be redeemed. However, there are typically no severe penalties if the company fails to meet the redemption requirement. Then, as far as the maturity is concerned, we can also discuss whether a preference share is a convertible preference share or non-convertible preference share. So, if it is a convertible preference share, then the maturity period of preference share would be similar to those of the equity share, because if the conversion right by the preference shareholders have been exercised, then at the end of the maturity period the same preference shareholder would be converted into equity share, and it is only after the conversion the preference share would be treated as an equity share in terms of the maturity as well. Then the second feature can be discussed with the help of claim on income and the claim on assets. So, whether the preference shareholder has a claim on income and asset of the company can be segregated into the other three subheadings. Number one is priority of claim. So, priority means if there are three parties financing the assets of the company or through which company is procuring fund like debt, preference share and the equity capital, who are the party, which party is going to receive the dividend or the interest first? Here preference share, as I told you, that it is a hybrid security. So, this means it has a prior claim or preference over equity capital both on the income and asset of the company, but it has a claim only after debenture have been paid the interest as well as the principal whenever it is due. So, that means the preference share must be paid in full before payment of any dividend on the equity capital, and also in the process of liquidation the whole of preference share capital must be paid before anything is to be paid to the equity shareholder. So, that means they enjoy the priority over the equity shareholder, but after the debenture holders. Then comes the second feature, which talks about the certainty of claim. Certainty of claim arises from the fact whether the company, if incurring no profit, are liable to pay dividend to the preference shareholders or not. So, here comes the role of the preference share and its nature. Like if the preference shares are of cumulative nature, then the cumulative dividend would be paid to the preference shareholder for the last year as well, because when there was no profit, it was not paid. But when the profit has been earned by the company, the dividend would be carried forward and would be paid before any dividend is paid to the equity shareholder. I hope you have understood the concept of cumulative preference. That means the dividend of the last would be accumulated, and along with the dividend of this year, it would be paid to the shareholder. Now, the claim of income can also be discussed under the head amount of income, like whether the amount of dividend is fixed or it is flexible. Then the amount of dividend on preference share is fixed, because the rate on preference share is something which is fixed prior to the issuing of preference share, and this would be fixed and will be expressed as a percentage of par value. But it is not a legal compulsion to the preference shareholder to pay or to receive the dividend by the company every year, even if there is a profit that have been earned by the company. Then comes another relevant additional feature of preference share, which says that if there is extra income in the company, whether they can have a claim on this income or not. So, again there is some associated feature or relevant feature of the preference share, which says that if the preference share is a participating preference share, then they would be entitled to claim the surplus profit of the company. That means profit remaining after payment of their fixed dividend and equity dividend at a specified rate. So, that is how the amount of income on the preference share tend to vary from time to time, depending upon the nature of preference share, whether it is a participating preference share or non-participating preference share. Then comes the discussion on the participation in assets while company is going for liquidation, and it is said that preference shareholders are entitled to a share in the residual assets of the company after two conditions. Number one, when the company has settled all its debt, that means debenture holders have been paid in full, their interest and principal both have been paid by the company, and there is no obligation on the company as such. And secondly, the capital amount to preference shareholders and the equity shareholders have also been returned by the company, and only when there is a surplus left after this, the preference shareholder can participate in the assets remaining with the company. Now, the next important question is whether the preference shareholder has some voting right or not. Practically, since preference shareholders enjoy a fixed rate of dividend, they also has a right to participate in the extra income of the company if it is a participating share. They can also claim the last year's dividend if it has not been paid. Then they are not having much controlling power in the company, just like the equity share. But in some rare circumstances, when the preference shareholders have not been given dividend, especially when it is a cumulative preference share, then they are given some right to vote in the important resolution. For example, if the company is undergoing merger or company is getting liquidated, then they can cast their vote. But normally the preference shareholders do not have any voting right. So can we now sum up the classification of preference share under different head? Number one, as far as maturity is concerned, we can see three kind of classification. Number one, redeemable or irredeemable. That means whether the preference share would be redeemed or it will be paid back to the shareholders after the maturity period or not. So on that basis, it can be redeemable if it is paid, irredeemable if it is not paid. Then they can be convertible versus non-convertible preference share. That means whether the provision for conversion of preference share into equity share has been inserted in the issuing clause or not. So if conversion feature has been attached, normally it would be converted into equity share in any proportion. Maybe 2 preference share can be converted into 1 equity share of the company, depending upon the terms and conditions or the clauses that have been agreed upon between the company and the preference shareholders. Similarly, if it is a non-convertible preference share, of course, the maturity will come to an end after the definite or after the due date. It is certain that at the time of maturity period, after the maturity period, it will be paid back if the no conversion provision is attached to it. But there are certain circumstances where if company feels can also pay back their preference share even prior to maturity period. So that is called the callable preference share, and here by offering 1% or 2% of premium, company can redeem the preference share even before the maturity period. If there is no such provision, then it would be termed as a non-callable preference share. Then based on the claim of income, if it is the certainty feature that is to be seen, it could be cumulative versus non-cumulative. As we have discussed, cumulative preference share makes the shareholder entitled to receive the dividend on the preference share of the previous year as well. Participating, non-participating, that gives the shareholders a right to claim on the surplus income generated by the company. Claim on assets, as just like the equity share, the fixed asset of the companies are not kept as collateral for issuing the preference share, then even during the liquidation, they would be, prior to liquidation, they should not be giving any right to the preference shareholder to sell the asset and realize their capital and the dividend from the company. So as such, there is no claim on fixed assets of the company by the preference share. And controlling power, yes, in some exceptional cases when the dividend has not been paid, in order to protect their right, they can cast their vote in important resolution of the company. So these are the discussion on the types of preference share, redeemable, irredeemable, and so on. We have done with all these features. Now can we move to the advantage of preference share for the company and also for the investors. If a company raises capital through preference shares, what are the advantages, what are the benefits it is expected to get from it? Number one, the company will be paying fixed return. That means they have got very less possibility to claim the additional income of the company. Flexibility in capital structure, that means the shareholders can be called back by the company even before the maturity period. We have just discussed the callable preference share. So in that case, if the company finds that the preference share capital has become burdensome or company has headed towards the overcapitalization where the earning is not matching with the amount of capital base that the company has prepared, then company can redeem the preference share even before the maturity period and can have the flexibility in the capital structure. No burden on finance, that means the dividend payment is not a compulsion, so company is under no threat to pay dividend. No charge on assets, since assets not kept as security. So here the asset of the companies are intact, and one good benefit of this point can be that these assets which are not kept as security can be offered as a security while issuing the debenture capital in the market. White capital market, that the investors can be found out for subscribing the preference share, and there is no fear of liquidation or bankruptcy because there is no such clause which gives right to the shareholder to sell the asset in the market in when the dividend has not been paid. Here investors are also going to gain a lot while holding the preference share. Number one, regular fixed income. What is regular and fixed income? It is because of the fact that the as long as company is incurring profitability, then company is expected to pay a fixed amount of dividend to the preference shareholder. So this gives a kind of regular flow of income to the preference shareholder, and also the amount is fixed, so they don't have to worry as whether they will be getting dividend, or if yes, then what should be the amount like the equity share. Preferential right, that means in case there is lesser profit, so they have got every possibility that the dividend would be paid before the dividend is paid to the equity shareholder. So this preferential right is actually an added lucrative feature of the preference share. Then though they are not given any voting right in normal circumstances, but yes, they get voting right in exceptional cases when the company is passing through certain difficult time and has not been paying dividend. Lesser capital loss. It is due to the fact that they have got the priority in terms of claim on income and claim on assets. The liquidation of the company would also result in a lesser loss to the preference shareholder, because just after making full payment of interest and principal to the debenture holders, the preference shareholders can get their paid up capital from the company. Then as there is no such thing which is free from the problems, so is the case with the preference shareholder. There are certain limitations of the preference shareholder to the company and to the investors. So company will be under pressure to pay fixed amount of dividend to the company, although it is not sharing any voting right with them. Then company would not be getting any tax advantage which is available in the case of debentures. I will be discussing later on. Here when we calculate tax liability on debentures, first of all we have to deduct tax interest from the earning before interest and taxes. Only after paying tax interest we calculate the tax liability. So here we interest being the tax deductible item, the liability of the company in terms of taxes lowers down in the case of debt capital, which is not available in the case it is the equity financing or the preference share financing. Then another disadvantage of the preference share can be like there is no certainty of finance, because it is somewhat risky capital. Even a company comes with the issue, there is no guarantee that the investors would take interest. They would find interest and subscribe the preference share capital, preference share which has been issued by the company, and it is not available in recession, because again the riskiness of the security would prevent shareholders from taking the risk, and as a result during recession, during tough time when there is no other mode of finances available to the company, preference share can also be a limited choice for the company. And for the investors, no voting right given to the investors. Normally we have seen the exceptional cases, then they cannot have the share in the additional income of the company unless until they have the participating preference share. Then uncertain redemption, because even at the time of maturity, if the company is short of capital, they may not find it easy to redeem the share capital preference shares, and as a result their capital may remain with the company and will not be redeemed even after the maturity period. Then no guarantee of asset, as we have seen the asset of the company are not kept as collateral, then at the time of liquidation the preference shareholders again their capital. So these are the disadvantages to the preference share holders and also to the company. And let's discuss a very important phenomena why preference share is called a hybrid security. And the reason is very simple, because we have seen on some of the criteria they are very close to debentures, but on some criteria they are very similar to those of the equity shareholder. That is why we call them as a hybrid security. Let's see what are the features which makes it very close, very similar to the debentures. So number one is it carries a fixed or rate of dividend. Just like the interest on debenture is fixed, the dividend on preference share is also fixed. Second, that it ranks higher than equity as a claimant to the income or asset. They enjoy the preferential right over the equity shareholder, just as the debenture enjoy the preferential right or the priority over the equity shareholder. So that is how it is very close to the debentures. Then in the normal circumstances, the preference share do not carry any voting right, and so is the case with the debenture holders, and they normally do not have any claim, any share in the residual income or residual asset of the company. Now let's see on what ground the preference share attributes are similar to those of the equity shareholder. Number one, on both of these securities, like on equity share and also on the preference share, the dividend is paid, not the interest. So dividend is the portion of profit which is paid to the preference shareholder as well as to the equity shareholder. That means it is non-tax deductible. That means do not have any extra motivation for the company to issue preference share, just like unlike the debt capital. Then whenever the profit is being generated by the company, the management is not under the compulsion to pay dividend. So it can retain the profit for investing into some profitable, some very promising projects which is available in the company right now. It is an non-obligatory payment. Okay. Then irredeemable type of preference share have no fixed maturity date. As we have seen that equity capital is a permanent capital having no maturity date, it would remain in the company till the company survives, unless there is one clause of buying back of shares. The preference share, if it is irredeemable or if it is convertible preference share, will have the similar maturity period just like the equity shareholders. Now, after we have discussed the concept of preference share, the features of preference share, its classification, the whole spectrum of preference share based on the maturity, the right to participate in the income of the company, whether it has a claim on the previous year income or not. We have seen a massive classification of the preference share. Now in the last segment we shall discuss the preference share as a source of finance, when the company should bank upon this security. So number one is when the company's earnings are less but unstable. So here when the company is incurring low profit as well as the profitability is not guaranteed, that means it is fluctuating over the years, then it is better not to issue the debentures where the interest is a obligation for the company. So it is good to issue the preference share. Second, when the market price of share is low. Normally when the shares are issued in the market, now they can be issued at premium. So if the market price of the share is low, then the investors' confidence would not be as much as in the case when it is high, giving a signal that company is enjoying high credit worthiness in the market and also the good reputation. But this has a the drawback as well, because when the market price of the shares are very high, it also gives a illusory concept that the company is overvalued. So maybe that the share would not be issued at premium, or there will be lower rate of subscription even if the shareholders are ready to buy the security. When the cost of fixed security is high, that means when the cost of debenture is very high, I mean the company is already overburdened with the debt and also the rate of interest is very high, it is better to avoid the security and go for the preference shareholder. When the ratio of profit and equity is high, when the ratio, debt equity ratio probably is high, then further issue of debt is not possible by the company. So better to go with the preference share. And when the company is already facing a great amount of interference from the management, then equity shareholder could be avoided and their interference could be lessened just by issuing the preference shares. So these are the conditions where preference share seems to be a more suitable option for the company. But yes, since it is a hybrid security, we must due consideration to its pros and cons, and then finally we should take the decision whether to go for it or not. So with this, we again come to an end. With this, we have come to an end with the deliberation on the preference shares. I hope you like the lecture, but still if you have any query, we are eager to look forward and to solve them. Thank you very much.